uncertain economy and a tumultuous market environment are affecting the timing of several highly anticipated IPOs. And the delays and difficult conditions are only complicating matters for venture capitalists trying to raise funds for new ventures. To discuss both the current problems and future potential of high-tech IPOs, I'm joined by Mark Heesen. He's the president of the National Venture Capital Association. Mark, welcome to Bloomberg West. Great to have you here on the show. So, Groupon has delayed its IPO. This is a record year for delayed, canceled, postponed IPOs. This must be a big concern for you.
It is a concern. We started out at the beginning of the year actually doing pretty well. We had a number of companies go public, and then about 8 weeks ago, we've really seen the ice form on the river of IPOs, and it's been very difficult to see companies go out.
So what does this mean for the venture capital industry? What does this mean for their ability to raise more funds?
What it means is that we have to hold on to our companies longer, which means that we have to put more money into these companies, which means we have less time to invest in new companies. And it also means that our investors are not getting their money back in an efficient manner, which means they're not going to give us new money to reinvest.
Exactly. I mean, aren't investors going to be more risk averse? I mean, there was so much hope riding on the Groupons and the Zyngas.
And you saw a pretty positive first half, and that's what's so unfortunate here, that the last 8 weeks have been tough. And I think that, unfortunately, with the government policy and Europe and a number of things going on, it's hard to see things getting progressively better quicker in a quick fashion. So you're going to see, I think, both the market continuing to be unstabilized and investors still kind of sitting on the sidelines waiting to give us money.
Now, Groupon raised a monster round of VC funding earlier this year, $950 million. A lot of that money went to cash out founders and early employees because of the existence of these secondary markets. Have you guys learned anything now about the risks of potentially excessive founder liquidity?
Well, it is a double-edged sword. You want to keep entrepreneurs hungry. You don't want to starve them. And so you have this quandary.
Do they need hundreds of millions of dollars?
Right. You have this quandary right now that you want to be able to incite employees, but you also want to make sure that at the end of the day, we're all in the same boat together and we all get rewarded at the same time. And that's really a tough road that we're navigating right now, is to see who actually comes out.
But have investors learned anything from this? I mean, are they now saying, well, if we're going to give you money, we want you to use it to build the business? Yeah,
I think that more and more you're seeing folks who say the money needs to basically grow the company. Simultaneously, you want to have happy employees who are going to get up in the morning and come to work and work those 20-hour days.
I would definitely be happy if I had $100+ million. Let's talk a little bit about the broader implications of these secondary markets. We know the exchanges are working with some of these companies to make them more amenable to this practice, but that the SEC has been looking into this. Where do you think regulators are going to fall on this?
I think at the end of the day, they may give more leeway to the secondary market. The question is that now I think venture capitalists are literally putting up more roadblocks so that it's going to be harder for companies after the ones that are being funded today to actually take part in the secondary market.
So the secondary markets have certainly disrupted the industry. Is it all for better, or is some of it for worse?
I think some of it's for worse. I think you want to make sure that all of us are aligned and going in the same direction. And if some people get rewarded before others, there is that sense that there should be some sort of equilibrium here. So I think there have been some downsides to the entire area. At the same rate, because it takes so long to go public today, you need to give somebody some sort of hope earlier on in the process.
All right, Mark Heesen of the National Venture Capital Association, thanks for sharing those thoughts here.
Thank you.
On Bloomberg West.